background on myself. As Mark said, we got together when I was in the lending industry. I made a lot of money from 1985 to 1993 as a realtor when the market was awesome in the Northern Virginia area. I'm from Annandale, went to Annandale High School, grew up in this area, got into real estate, got into commercial real estate, and then got out of that business and went into the software industry and designed a couple of programs. The program that I use for my credit side is a program that I helped design. So it's a very customized for each individual client. So I've got a little bit of background in the realty market. I got some background in the lending side of it. And the reason I got into credit restoration is because I was very fortunate to grow up with two parents that drilled good credit into me as a kid. And I was constantly, by them, learning about it. And the more I got into it, the more I really liked it. And I've never had bad credit. And it's not hard to get into bad credit ways. It happens to good people all the time. And I work with a lot of those. But I was able to take my love for the credit industry itself and my loathing for the credit bureaus and put it into something that now basically I enjoy doing. I got in the lending industry. I got caught up in the subprime collapse. I spent more time helping my clients get their credit squared away than I did closing loans. So I said, forget it, I'm done. I'm going to go into a market that I know I can be effective in. That's how I got into this business 6 years ago. I worked with over 250 loan officers from here to California and realtors. I've worked with over 2,000 clients. And my program of credit restoration offers a refund guarantee, which is very simple. If I take a client through the process and I'm unable to raise their credit score, I will give them a refund for anything I can't get off their credit report. To date, I've refunded zero. I've not had a client I could not raise their credit score. It can be done no matter what you may think you know or don't know or believe or don't believe. If you do it properly, the way the law requires you to do it, you can get things off credit reports and scores will go up. So that's a little bit of a background about what I do and how I got to this point. How many of you in here have helped a client with credit issues on their credit reports? Excellent. Okay, how many of you feel you have a good understanding of the credit reporting industry itself and how that process works? Excellent. Okay, good. So if I say something that you feel is incorrect, please bring it to my attention. And we'll address it. Because you're going to hear things coming out of my mouth that you may have heard different from somebody else. Unfortunately, the credit industry in general is a dark industry. There are people that do what I do that don't do it very well and charge a lot of money for it and can hurt somebody's credit before they can even help it. So, any questions before we get started? Excellent.
The breakdown, Scott, is probably about half agents, half non-agents.
Okay. All right, well, that's what I figured you said earlier, so I tailored it. What I'm going to do is I'm going to jump right into the meat of what it really is. This is one of my favorite quotes, and today this still holds truth. That credit is a system whereby a person who can't pay gets another person who can't pay to guarantee that he can pay. That pretty much sums up what the credit industry is. Inaccuracy on credit reports. A few years ago, a company did a 15-year study on credit reports and found out that 79% of all credit reports contain inaccurate information. Now, it's a mix of different things. It can be the wrong address. It can be a miscellaneous name. It can be an account number that's incorrect. It can be the wrong social security number. But 79% of every credit report that comes out the door has an inaccuracy in it. 54% contain inaccurate personal information. 30% list closed accounts as open. I run into that more than anything else. 22 have the same mortgage listed twice. 8% report simply don't list major credit loans. A lot of lenders, some lenders, some credit card companies will not list the credit bureaus to save money. So if you have a client who has something that should be on their credit report that isn't, it's easy to get it on there. You just have to know how to go about doing that. 1 out of 4 consumers are inaccurate, and they're denied credit because of it. Now, how many of you check your credit reports on a regular basis? Okay. I would check it personally. I have a monitoring system that I use that I enjoy, and it lets me know if anything changes, but 3 months minimum on your credit report checking. Because of the identity theft laws that are going on in this country and the identity theft that is going on in this country, you should be on top of it at least every 3 months. And it's worth $9 or $10 to pay a monitoring company to watch it. The Consumer Financial Protection Bureau that was just formed and opened their doors in 2011. You know the first thing they did? They data mined almost 1 billion consumers' credit card and mortgage information into a system that can be hacked. So if you're not monitoring your own credit, you really, really should. Because has anybody ever gone through identity theft? Has anyone known anyone that has? It is horrible to go through and near damn impossible to get corrected in less than a year or two. The reason there are so many mistakes is because on a daily basis there are 30,000 data processors putting in at least 4.5 billion updates to credit reports. The credit bureaus get between 10 and 15,000 disputes every single day in the mail. And they have to open them, look at them, decide what the dispute is, and then load them into the system. Do you think there are going to be some mistakes? Absolutely. All the time. So understand this fact, and this is scary. Only 5% of the entire wealth in the world is printed on currency. The other 95% is on credit cards. So if you don't have good credit and you have to live off cash, you don't have access to 95% of the world's wealth. That's why credit is so important. If your score is under 600, you're in need of assistance in some way, shape, or form. And it's not hard to get the scores up. You just have to have a diligent plan and work it properly. Just want to touch base on this. We all know we've all been there. 2006, 7, and 8, the subprime market collapsed. And we know why, because of loose lending practices, low interest rates, and you could buy a home on a signature back then. And it was crazy. I can tell you a quick story. I had a lady when I was doing loans. I had a lady who lived in McLean, and she lived in a $1.2 million home, and she wanted to refinance. And she was a housekeeper. But she had an 820 credit score. So, back then, it was all based on that number, all based on credit. U.S. mortgages defaulted all-time high. The property values dropped and foreclosures are still going on. Credit securities collapsed. Banks took huge loss. The government came in, bailed everybody out. Bank of America still reeling from the subprime collapse. Chase, look at Chase. Where's Chase? Same thing. Bank of America was the first bank to actually start lowering credit card amounts and raising interest based on the general risk clause of a credit card application. They were ghosting people's credit, looking to see who had trouble across the board with other credit cards, and they were the first ones to go back and say, we're dropping your 10,000 to 8,000 because of the risk factors. And they still do it. Actually they can't now, but I'll tell you something that they're still doing kind of under the table. I think the credit markets are still suffering from the subprime issues. Okay, this you're gonna love. Before the subprime collapse, this is what credit scores really look like. 730 to 850 was excellent. 680, 729, good, very good, good, fair. Below 500, you couldn't get it. The average score was between 40 and 60 points. Differences before the subprime collapse. After the subprime collapse, an 801 to 850 is considered excellent. 851 to 800 is good. Look at where poor falls. 601 to 650. Can we turn the air down a little bit or something?
Yeah,
I'm warm. I know everybody else is going to end up being warm.
should be right behind you guys. Turn the AC on.
Now the differences between the three credit scoring can be anywhere from 40 to 100 or more points. And just to touch base on that for a second, is everyone aware why their three credit scores are different? Let me explain it to you, and we're going to cover it in more detail, but all three credit bureaus are private entities. They're all private-owned companies. They're out there for money. Equifax made $1.5 billion last year selling credit data only, credit reports, not even all the other stuff that they do. The credit bureaus don't communicate. Each credit score is an individual credit score based on how that credit bureau wrote the software to calculate all the algorithms that go into scoring. A lot of credit card companies won't report to all three. They'll only report to one because it costs money to report to all three. So they report to one bureau or they report to two. So the reason you have the differences and the reason lenders use the middle score is because if TransUnion's the high score and Equifax is the low score, they'll use the Experian score. But the reason the scores aren't the same is because the data is not reporting across the board at each bureau. You may have one credit card company that only reports to Equifax and doesn't report to the other two. So that's why your score variances are the way they are. The other reason is the credit bureaus themselves have their own software that they tweaked with the FICO software. So they have different risk factors built in. That's why the scores are different between the three bureaus as well. Any questions on that? So I just kind of flew through it. Okay, everybody understand that? Okay.
What was the minimum before? Before that debacle?
40 to 60 difference, and now I've seen it as much as 180 between an Equifax score and a TransUnion score. And that's because most people report to TransUnion and won't report to Equifax. And interestingly enough, TransUnion is one of the easiest to get things removed from. Okay, are we still in a credit crunch? That's a question I get asked on a regular basis. How many of you think we're still dealing with the effects of the 2006 and 7 prime? Okay, you're starting to see now, you're absolutely right, you're starting to see now lenders, I just had a lender tell me he now can do a 580 loan with all these stipulations, trying to put in a square peg in a round hole. But now you're starting to see a little bit of leeway on what you can get done with some different lending institutions now. In a credit crunch, they stop lending, credit becomes tough, but in our economy where we live and breathe and spend, I think it's still around. I see it on a regular basis. Banks are still lending, credit card issuers are still issuing, and mortgage lenders are still refinancing. HSBC, the largest credit card company in the country, is even, I think it's an English company, has pulled back on their lending practices because they're getting hit with so many defaults and so many things going on. Still, indication of the crunch. Here's some new things that have come along. Fair Isaac, they reevaluated their scoring software in 2009, and they just revised it in 2012. And what they did is they're trying to make it softer of an impact for different things that people have on their credit reports that are negative. All three bureaus have updated it to reflect this new scoring model in the current market, and they've also factored in a future declining market. So they've already built in risk in a declining market down the road. That's why, I don't know if you all know that when they redid this in 2012, if any of you can think back to 2012, if you looked at your credit report and the next day after they revised it, you looked at it again, it dropped anywhere from 20 to 40 points for no reason other than the fact they put this new software in, which built in the risks that they had been working on. So what they've tried to do is they've tried to make it more acceptable so people have a higher credit score even if they have a little bit of negative items attached to the report. Like a $200 collection or less doesn't have, well, it has a little impact, but hardly that it used to in the past, is one of the things they've done. 30-day late mortgage before the subprime was 20 to 30 points. You get a 30-day late now, it's 100 points or better.
What?
Absolutely.
I'll be right back. We'll go pick a mortgage.
Absolutely. I've seen it higher, and again, the reason is because of what's going on with the mortgage industry. It's coming back around. 80% use of credit cards is considered maxed. How many of you live by the myth that if I run my credit up to $1,500 and I pay it off next month, that's the best way for me to get a credit score? Okay? Unfortunately, it doesn't help you in a standpoint of active credit. What the credit bureaus look for in this respect is they look for the use of the credit card. They look for use of credit. If you have a credit card, for the sake of numbers, has $1,000 available balance, and you charge $300 on that card, you're at 30%. You're above the 29% threshold. Anytime you get above 29%, your scoring starts to go down instead of up. So if you use up to $290, you may get 18 good points. Let's say that card individually gives you 18 points towards your score. If you go above 29%, now all of a sudden, you may only get 16 points. When you go above 40, you may get 15 points, 14 points. When you go above 50, you may get 12. 60, every 10 point is a break. When you get to 80%, they score the card as maxed. So if it was 18 points for a good card, if you get to 80% of the use of that credit card, you may get 9 points of positive points. The one thing I'm constantly talking about and people constantly call me about, they go, I pulled my credit score, I can't believe it. My credit score's gone down 60 points, why? And first thing I'll say to them is, did you use revolving credit for Christmas? Well, yeah, we use credit cards for everything. And where are the balances? Well, they're almost maxed. And that's the immediate reason. If you pay the credit cards down under 29%, as soon as they re-report it, you'll see your scores go right back up. If you have a client who says to me, I got to get my score up 5, 6, 7 points, as a realtor or a loan officer, if you want to look at the credit report, look at the revolving credit line. Look at the balance available and the balance used. Have them pay that balance available down under the 29% mark. They don't have to pay it off. There's no difference in scoring between paying it off and getting under 29%. Just get them under 29%, have them call the credit card company and say, hey, I just made a payment, I need to get it reported sooner rather than later because I'm trying to get a mortgage. And 9 times out of 10, they'll help you out and do it. And then that score will be reflected. That's the quickest way to get a score up if you have a client who needs to get a couple of points or needs to get their score up. Yes, ma'am.
I use my credit card all the time. And so if I use it and I max it out in a month, but I pay it all off, because I get points, I get double points. And so I use it for everything. When do they report it? Like if I'm paying it off within a 30-day period? Or is it because I've used it that entire month?
They usually report the second Tuesday or second Friday of every month. They'll do their electronic transfer. You can call somebody and have them report it sooner if you ask for a supervisor and go up
But I
the
can
chain.
use it without penalty as long as I
Yeah.
pay it up before it's reported.
Yeah, and you're only going to see negative points if you're looking to pull credit. If you were to pull credit when it was maxed, you'd see a lower score than when after you paid it off. So it really, because credit's always liquid. It changes minute to minute, moment to moment. So if someone pulls credit when the card's maxed, you'll see a lower score than when the card's at zero. But to maximize the effort of credit, revolving credit, you want to have your cards active. Let's say you have 3 credit cards, and each of them has a zero balance. Okay, if those cards, and together they may score 75 good points for you. If those cards were active and they were being used and you were making monthly payments, you may get 95 points out of that, because they're looking for the a mix of credit and those cards being active. If it's a zero balance, it's scored as inactive. Like if you had a one card at 0 and a card at 5 cents, the 5-cent card would score 15 points. This would score 10. And the only reason is because this is not an active card, so it's not used as an active line of credit. It's used as non-active. So, and I know it's a pain to pay the interest and to pay the credit card bills every month, but if you have a client who says, hey, I really need to maximize my score for the next 3 months, well, have them put a tank of gas on a card. Have them pay 2 months on that card, because now it's active and it's scored as an active card. That's all they really need to do. Never pay the minimum payment. Never. Always pay at least $1 more of the minimum payment. $1 will keep you from being red flagged. Minimum payment cards are looked at and constantly by credit card companies because it's an indicator of you're in financial stress if you're only paying the minimum. Because you know how long it takes to pay a minimum card off? 5 or more years. And if you pay $1, you never get in that pocket. You never get flagged. So always pay more than the minimum amount for your own benefit, but for your credit score benefit. Sorry, I kind of went off on a tangent. Any questions on that before I move on? Yes, ma'am.
You say they report the second Tuesday or Friday of every month?
Usually they'll electronically transmit, well, the second Tuesday or second Friday of every month.
But each card is different, so we need to call our credit card company to find out when they do that? Okay.
I would. And that was a while back. I haven't looked into what's going on nowadays, but a year or so ago, that was the times. Most of them will do the electronic transfers in one big batch. Yes?
I'm sorry, I think you explained it, but I just want to make sure. Zeroing out the credit card every month is not helping. You want to leave some amount of balance on the card to show that it's being used. So charging up $1,000 and paying off $1,000 every month, it's not helping.
Well, don't get me wrong. It does help you. It helps you because you're in control of your finances and you're not running balances. But from a scoring standpoint, if that card, because you're paying it off, it would not score as high as if it had an active balance on it. And it could be, depending on your credit structure, everybody's credit DNA is different. So your line of credit from the day you started to now is built around thousands and thousands of different algorithms. So that may be 4 or 5 better points. But if you don't need 4 or 5 better points, it doesn't matter. If you've got good lines of credit, good installment, good revolving, you've got everything you need to be, someone like that, it's not going to be a big benefit to, because you're paying it off every month. You're not using credit. Why do you need the extra points? But to maximize cards, you want to have revolving cards. I mean, if you have 3, the credit card companies will close a card if it's not used. And you know what happens when they close a card? You get hammered. Scores drop, I can't even tell you. 150 points, 100 points. You lose a line of credit that's a positive line of credit that's got more than a year behind it, your score is going to tank. And you don't have any control over it. It's in the small print. If that card's not being used, they're not getting any money out of it. By right, they can close it. They don't have to tell you. They just close it and they send you a letter and said, because this card's been inactive for 6 months. So I would use your credit cards every 6 months. If you want to rotate them, buy a tank of gas, buy some groceries, go on whatever you want to do, and then pay that card for 3 months and then go to the next card and just rotate them around.
So what if you close it yourself?
Oh, don't. Yeah, don't. Same thing. That's the worst advice you could ever give to anyone. And lenders do it all the time. And I'm telling you, if any one of your clients comes to you and says, my lender told me to close a couple accounts because I have too many outstanding accounts for my debt to income ratio, Say, no, 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 no. Get it in writing from the lender that if you close these accounts to get your loan, that they will give you the loan. Because as soon as you close a positive account, your credit score goes right down. Because it's taking away one of the positive trade lines that drives your score. And the other thing is if they're revolving accounts, let's say you have 5 credit cards. And for the sake of numbers, each one's $1,000 available balance. Well, that's $5,000 of aggregated, the total aggregate of credit available, $5,000. And let's say you have 3 of those cards have, $1,000 on each. So you're at 3,000 versus 5,000. So you're looking at what, 70%. Let's say you close one of the cards you're not using. Well, that $5,000 balance now becomes what available? 4,000. That 3,000 that you had at 75%, guess where it is now? 90%. Guess where it's scored? 90%. So when you remove a line of credit that's used to calculate your total revolving debt, it immediately pushes your balances that you've used up into a higher category, and your credit score goes down. Don't ever close an account. If a lender wants you to close accounts because of DTI issue, front or back, make them get it in writing. Say,
DTI is what?
debt to income ratios. Oh, I'm sorry, my bad. Debt to income ratios, because they take a front debt to income and they take a back debt to income most of the time. At least they used to, as far as back as I remember. So if a lender says, oh, you got to close this account because this $10,000 credit card, we don't want you using it. Don't advise your client, absolutely not. Call me, get the lender to put it in writing to say, hey, okay, if you do this, we're still going to get you, because I guarantee their score is going to go down. And then they're going to come back, and then they're going to come back, and they're going to say, oh, why did you tell me to do that? Okay, you're going to love this part. Insurance companies, employers, apartment managers, utility, junk mail solicitors, and everybody else is now starting to use credit scores. Car insurance underwriters, here's an interesting thing.